Hi, this is Jack Crooks from Money Markets TV. Last week, the Federal Reserve and other central banks around the world announced a coordinated effort to inject liquidity into the credit markets by lowering the price on existing dollar swaps. This type of collusion has only been tried twice before, in December of 2007 and then again in September of 2008. As you can see, the stock market didn't exactly have a positive reaction to these moves. In fact, both instances were followed by months of selling pressure on the S&P 500. This is quite a difference from the extreme positive reaction investors had to the Fed's 2 rounds of quantitative easing. QE1, instituted at the end of 2008, sparked a rally that lasted more than a year, and QE2 was largely responsible for boosting stocks through the first half of this year. So what type of reaction can we expect after this latest move? Well, so far, it seems extremely positive. In fact, investors responded by pushing the Dow to its biggest one-day gain in more than 2.5 years. But I'm extremely skeptical that this optimism will last. First of all, we know that the European sovereign debt crisis is not improving. Far from it. And we know that the stopgap solutions proposed by the Eurozone leaders cannot really succeed. Second, China's economy is starting to sputter as well. Mainstream investors have been so consumed by the crisis in Europe that they've ignored clear signals of a hard landing in China. Last week, the country's central bank cut the reserve requirements for Chinese banks for the first time in 3 years. This is an admission that the government is not comfortable with the slowdown in industrial and real estate markets. 2 separate purchasing manager indexes, one from the state-run agency and one from HSBC, showed that China's manufacturing sector contracted at a faster pace than expected last month. As China's economy slows down, the market sentiment toward the country is dimming. Just look at the benchmark Shanghai Composite, which has been falling steadily for nearly a year. This negativity hasn't shown up in the currency markets yet, but it's only a matter of time. Australia is heavily exposed to China and can even be called a satellite economy. But as you can see, the Australian dollar has not declined along with the Chinese stocks. In fact, the Australian dollar has enjoyed a recent spike against the US dollar. But I believe this rally is unwarranted. Eventually, the signs of China's slowdown will become too obvious to ignore, and investors will reevaluate their affinity for the Australian dollar and other risk currencies. Right now, the markets are still caught up in a euphoria over the coordinated central bank action. But soon, investors will realize that the move cannot solve the sovereign debt crisis or boost China's economy. And when that happens, they'll lose their appetite for risk. I'm Jack Crooks from Money Markets TV. Thanks for watching.